Welcome back, everyone. Let's jump right into today's explainer. We are strapping in to cut straight through the noise and decode the massive market crash of June 18th. Think of this like a dynamic shockwave analysis. We're going to track the energy of this crash from its absolute epicenter right out to the furthest edges of the digital asset space. Let's get into it.
Over a breathless 13-day stretch, we just witnessed a staggering multi-billion-dollar capital flight from digital assets. I mean, it left retail traders completely stunned. So, you've got to ask yourself, what kind of force is powerful enough to trigger a mass exodus of institutional money on that kind of scale?
14, that's our number. This visceral number represents the crypto fear and greed index, officially trapped in extreme fear. The market wasn't just dipping, you guys, it was bracing for impact. And the epicenter of this macroeconomic storm, well, it wasn't a crypto protocol hack or some sudden regulatory ban, it was actually something way more traditional.
Section 1. The Fed's hawkish shockwave. Okay, let's dive into this, because the ultimate catalyst for all this market damage came straight from Washington. In the very first Federal Reserve meeting under the new chair, Kevin Warsh, the market was absolutely blindsided. Now, on paper, they held interest rates steady at 3.50 to 3.75%. That alone wasn't the shock. The real surprise was the tone. They delivered a massive hawkish surprise. Basically, they prioritized fighting inflation over boosting the economy, completely incinerating any lingering hopes for rate cuts in 2026. They essentially told the market, hey, no relief is coming.
And this is the number that hit risk assets like a neon-colored energy strike, 3.8%. This was the Fed's updated dot plot. That chart showing exactly where each official thinks interest rates are heading. By projecting a median year-end rate of 3.8%, they signaled that liquidity was going to stay brutally tight.
Instantly, prediction markets violently recalibrated. We're now looking at a 50.5% chance of at least one rate hike this year. I mean, wow, the dreaded higher for longer narrative has been totally cemented. And as we know, when traditional risk-free yields stay high, speculative, non-yielding assets take the hit.
Section 2. Bitcoin takes massive damage. Let's track how this macroeconomic energy blast directly struck Bitcoin's underlying price structure. The second the Fed's stance became clear, Bitcoin's chart just started flashing red. The price plunged right through that critical $64,000 support level, dropping as low as $63,583. All those recent relief gains, poof, completely erased. The market was suddenly testing a really fragile technical inflection point, staring down the barrel of a deeper drop into the $60,000 liquidity zone.
And naturally, this triggered a bruising wipeout in the derivatives market. A massive $43 million in liquidations triggered almost instantly. As you can see, wrecked long positions accounted for a staggering 71% of the total damage. Over-leveraged traders betting on a breakout were absolutely pulverized, and that forced a cascade of automated selling that just accelerated the whole downward spiral.
Section 3. Institutional outflows accelerate. But hey, it wasn't just retail leverage getting crushed. We're talking about a rapid, calculated retreat from traditional finance. On June 17th alone, U.S. spot Bitcoin ETFs saw $82.2 million just bleed out of the system. But man, the 30-day picture is even more stark. $6.21 billion in outflows. This wasn't some one-day panic. This was a sustained, systematic, institutional de-risking over an entire month.
The absolutely crucial takeaway here is this. Bitcoin is acting like a high-beta macro asset right now. That means its price is moving in exaggerated, hypersensitive lockstep with traditional financial markets and U.S. Treasury yields. The grand institutional adoption narrative, the whole idea that Wall Street will just buy and hold forever, has temporarily stalled out in the face of tight money. When the Fed squeezes, institutions hit the sell button. Simple as that.
Section 4. Privacy coins get exposed.
But the shockwave didn't stop with Bitcoin. You might be wondering, why did privacy coins suddenly plummet while everyone was distracted by the Fed? This is a fascinating mini-narrative hidden inside the broader market crash. Because, well, when the entire market undergoes a massive stress test, hidden, micro-level vulnerabilities are violently brought to the surface.
The answer is a sudden, totally unexpected technical breakdown. Get this, an AI-assisted audit exposed a shocking 4-year-old vulnerability buried deep within Zcash's Orchard shielded pool. The core promise of privacy and security was suddenly in question.
Zcash plummeted 9% almost instantly, and the fear was so contagious it triggered a sympathy sell-off across the sector, dragging Monero down over 6% as well. It was a brutal 1-2 punch of macro pressure and micro vulnerabilities.
Section 5. Asian markets build infrastructure.
Now, while the Western markets were panicking and scrambling for the exits, unbreakable shields were actively being built in the East. The Hong Kong Exchanges and Clearing, alongside the Monetary Authority, quietly launched a pilot project utilizing their EHKD Wholesale Central Bank Digital Currency, or CBDC. Their goal? Enabling 24/7 margin payments for after-hours derivatives trading. This is institutional plumbing being upgraded in real time, so while sentiment in the US was crashing, Asia was basically building the rails for the next cycle. Section 6. Fear versus long-term conviction.
We really need to contrast the short-term noise against the underlying unbreakable long-term data here. There was a massive going divergence in the market. On one side, you have the short-term pain. Retail traders are terrified, the fear index is crushed down to 14, and open interest is falling 16%. But then look at the long-term shields. While the paper hands fled, diamond-handed veterans and long-term holders quietly absorbed an incredible 125,000 Bitcoin in June.
Beneath the surface, the data is just crystal clear. You have the spot ETF institutions actively de-risking, dumping $6.21 billion. But look at the corporate treasuries. Entities like Strategy accumulated another $100 million right into the teeth of the drawdown. And those long-term holders gobbling up 125,000 BTC, they aren't trading the Fed's dot plot. They are buying the signal at a massive discount.
So, I leave you with this final provocative thought. As the Fed's hawkish shockwave continues to echo through the digital asset space, blowing out leveraged longs and scaring off weak institutional capital, ask yourself, are you trading the macro noise or are you holding the long-term signal? That wraps up our explainer for today. Keep focused, stay curious, and I'll catch you in the next one.